A bank failure occurs when a financial institution becomes insolvent and is unable to meet its obligations to depositors and creditors. This can happen for various reasons, including poor management, excessive risk-taking, or economic downturns. When a bank fails, it can have serious implications for its customers, the economy, and the financial system as a whole. The process of a bank failing is not sudden. It typically follows a series of warning signs, such as declining financial health, increased loan defaults, and a loss of customer confidence. Understanding these indicators can help depositors prepare for potential risks. In many countries, regulatory agencies play a crucial role in monitoring banks and ensuring their stability. In the United States, for example, the Federal Deposit Insurance Corporation, or FDIC, is responsible for insuring deposits and managing failed banks. When a bank is on the brink of failure, these agencies step in to protect depositors. They conduct examinations to assess the bank's financial condition and may implement corrective actions to restore stability. If a bank cannot be saved, the FDIC takes over, ensuring that depositors are compensated up to the insured limit, which is $250,000 per depositor per insured bank. When a bank fails, the fate of your money largely depends on whether your deposits are insured. If your funds are within the insured limits, the FDIC will reimburse you, typically within a few days of the bank's closure. This means that even if the bank fails, your money is safe. However, if you have deposits exceeding the insured limit, you may face delays in recovering those funds. The FDIC will work to liquidate the bank's assets to pay off creditors, including depositors with uninsured amounts. This process can take time, and there is no guarantee that you will recover the full amount. The liquidation process begins when the FDIC takes control of the failed bank. They assess the bank's assets and liabilities, determining the best course of action to maximize recovery for depositors and creditors. The FDIC may sell the bank's assets, which can include loans, real estate, and investments, to recover funds. This process can be complex, as the value of assets can fluctuate, and some may take longer to sell than others. During this time, depositors with uninsured funds may have to wait for the outcome of the liquidation before they can access any remaining money. Bank failures can have a ripple effect on the broader financial system. When a bank collapses, it can lead to decreased confidence among consumers and investors, potentially triggering a wave of withdrawals from other banks. This phenomenon, known as a bank run, can exacerbate the situation, leading to further instability within the financial sector. Additionally, the failure of a significant bank can impact credit availability, as other banks may tighten lending standards in response to increased risk. This can slow economic growth and lead to job losses, creating a cycle of financial distress. To mitigate the risk of bank failures, regulatory agencies implement various measures aimed at maintaining financial stability. These include conducting regular stress tests to evaluate how banks would perform under adverse economic conditions, enforcing capital requirements to ensure banks have sufficient reserves, and monitoring lending practices to prevent excessive risk-taking. Additionally, consumer education plays a vital role. By understanding the importance of diversifying deposits across multiple banks and staying informed about their financial institution's health, consumers can better protect themselves against potential bank failures. If you find yourself in the unfortunate situation of having a bank fail, there are steps you can take to navigate the process. First, stay informed. The FDIC will provide updates regarding the status of the failed bank and the steps being taken to reimburse depositors. Second, gather all relevant documentation, such as account statements and identification, to facilitate the claims process. It is also wise to open an account at another financial institution to ensure you have access to your funds while the situation is being resolved. Lastly, consider consulting a financial advisor to help you understand your options and plan for the future. Deposit insurance is a crucial safety net for consumers, providing peace of mind that their money is protected up to the insured limit. It encourages individuals to keep their funds in banks, which in turn helps maintain liquidity in the financial system. Understanding the limits of deposit insurance is essential. For instance, if you have joint accounts or accounts in different ownership categories, you may be eligible for additional coverage. Being aware of these details can help you maximize your protection against potential bank failures. The psychological impact of a bank failure can be profound. For many individuals, their bank is more than just a place to store money. It represents security and stability. When a bank fails, it can lead to feelings of anxiety, distrust, and uncertainty about the future. This emotional response can affect spending habits, savings behavior, and overall financial well-being. It is important for consumers to recognize these feelings and seek support if needed, whether through financial counseling or community resources. Understanding that bank failures, while distressing, are managed through regulatory frameworks can help alleviate some of this anxiety. In conclusion, while bank failures can be alarming, understanding the mechanisms in place to protect depositors can provide reassurance. The role of regulatory agencies, the importance of deposit insurance, and the steps to take if a bank fails are critical for navigating these situations. By staying informed and prepared, consumers can mitigate risks and safeguard their financial futures. The financial landscape is ever evolving, and being proactive in understanding these dynamics can empower individuals to make informed decisions regarding their money. If you found this information helpful, please remember to like and subscribe for more insights and updates on financial literacy and security.